Here's a number that's been sitting still since 2009. £325,000. That's the nil rate band, the amount of your estate that passes to your family with no inheritance tax at all. It hasn't moved in 17 years, and the government has now confirmed it won't move again until at least April 2030. That single fact is the reason more ordinary families are paying inheritance tax than at any point in decades. Not because anyone got richer, because house prices went up and the threshold didn't. I'm going to walk you through exactly what's changed, what hasn't, and this is the part that actually matters. The small print sitting underneath every headline number, because in inheritance tax, just like in every part of the tax code, there's always a number and there's always a sentence. The number is what gets repeated on the news. The sentence is what decides whether it applies to you. Stay with me because there's a change coming in 2027 that will pull your pension into this conversation for the first time ever. And almost nobody has clocked it yet. I'm retired UK. Every week I take one piece of the system that affects people over 60 and I explain it properly. In plain English, with nothing hidden in the small print. If that's useful, subscribe because there's a lot moving in this space right now. Let's start with the basic shape of the tax because a surprising number of people get this part wrong. Inheritance tax is charged at 40% on the value of your estate above your available tax-free allowance. It's not 40% of everything you own. It's 40% of the part that sits above the threshold. That threshold is built from two separate allowances stacked on top of each other, and understanding both is the whole game. The first is the nil rate band, £325,000. Every individual gets it, regardless of what they leave or to whom. The second is the residence nil rate band. This one is worth up to £175,000. And here is the first sentence hiding under the number. It only applies if you leave your home or the value of it to your children or grandchildren. Direct descendants. Leave the house to a niece, a nephew, a close friend who cared for you for 20 years, a charity. And this allowance does not apply. The number says £175,000. The sentence says, only if it goes to your children or your grandchildren. Put those two allowances together and a single person has up to £500,000 that can pass free of tax. For a married couple or civil partners, it's better than that because whatever allowance the first spouse doesn't use transfers automatically to the survivor. That means a couple leaving a home to their children can shelter up to £1 million between them before a single penny of inheritance tax is due. £1 million. That's the number everyone quotes. And for a lot of families, that's genuinely the end of the story. No tax, nothing to plan around, nothing to worry about. But I want to show you the two sentences that quietly take that £1 million away from some families and leave it fully intact for others because this is where it actually gets interesting. The first sentence is about who inherits the house. I already told you that residence allowance only applies to direct descendants. So, picture two couples, same age, same size estate, same house. One leaves everything to their two children. They get the full £1 million shelter. The other couple never had children and they're leaving the house to a much-loved godson who has been like family to them for 30 years. That couple only gets the basic $500,000 from the two nil rate bands. The residence allowance simply doesn't switch on. Same wealth, same intentions, completely different tax bill, and the only difference is a line on a birth certificate. The second sentence is about the size of the estate itself, and this is the one that catches out people who think they're comfortably under the radar. The residence nil rate band doesn't just require you to have children. It also starts shrinking once your estate crosses £2 million. For every £2 your estate sits above that £2 million mark, you lose £1 of the residence allowance. Follow that taper all the way through and the allowance disappears completely once an individual's estate reaches £2,350,000. For a couple with both allowances combined, it disappears at £2,700,000. Now, I know what some of you are thinking. £2 million. That's not me. That's someone else's problem. And for most people watching, you're right. But I want you to actually do the sum, because this is exactly the kind of thing that sneaks up on people who did everything right. If you own a home that's grown in value over 30 years, plus a pension, plus savings, plus maybe a second property or a share portfolio, £2 million is closer than most people assume. It isn't a mansion owner's threshold anymore. It's a comfortable ordinary family home in the wrong postcode plus a lifetime of careful saving. Now, let me give you the change that I think is the real headline of 2026 and almost nobody outside the finance pages has understood it yet, because it hasn't landed yet, but the clock on it is already running. From April 2027, unused pensions will be brought inside your estate for inheritance tax purposes for the very first time. Right now, in 2026, your pension pot sits outside your estate. If you die with money still in your pension, it typically passes to your beneficiaries with no inheritance tax at all. That has been one of the single most effective, most widely used pieces of legitimate estate planning in this country for over a decade. Financial advisors have spent years telling clients, spend your savings first, Leave your pension until last because your pension is the one pot that skips inheritance tax entirely. From April 2027, that stops being true. Here's the sentence underneath that change, and it's the one that catches people out. It isn't just new pension contributions going forward, it's your existing pension pot, money you've already saved, decisions you already made under the old rules. That will be swept into your estate on that date if it's still sitting unused when you die. If you built a retirement plan around the idea that your pension was the tax-free pot to leave until last, that plan needs a second look before April 2027, not after it. Let me give you a picture of what that actually looks like in cash terms, using a simple, made-up example just to make the arithmetic real. This isn't a real person, just numbers, so you can see the shape of it. Say you're a widow with £500,000 still sitting in your pension that you haven't drawn down because you've been living off other savings and the state pension. Today, in 2026, if you died, that $500,000 would generally pass to your children with no inheritance tax attached. From April 2027, that same $500,000 gets added into your estate alongside everything else you own. If your total estate is already near or above your available threshold, a large chunk of that pension, potentially up to 40% of it, could now be lost to tax that would never have applied under the old rules. That's not a small print detail. That's a fundamental rewrite of how pensions and inheritance interact. And it's happening in 8 months from where we are right now. There's a third change worth knowing, even though it affects a smaller group directly, because it tells you something important about the direction all of this is heading. From the 6th of April this year, 2026, the unlimited relief that used to apply to farms and family businesses was capped. Previously, qualifying agricultural and business property could pass with 100% relief from inheritance tax, no matter the value. Now, that full relief only applies to the first £2.5 million of qualifying assets per person. Above that line, the relief drops to 50%, which works out to an effective tax rate of 20% on the excess. For couples, because the allowance transfers between spouses, that becomes a combined £5 million before the taper starts to bite. If you're not a farmer and don't own a business, this one doesn't touch you directly, but notice the pattern. A relief that used to be unlimited now has a ceiling. An allowance that used to protect everything now protects the first slice and taxes the rest. That is the direction every one of these reforms is moving in. And the pension change in 2027 is simply the next domino. Now, I want to give you the part of this that actually works in your favor, because it's real, it's underused, and almost nobody talks about it clearly. You are allowed to give money away during your lifetime, and if you live for 7 years after making that gift, it falls completely outside your estate, and no inheritance tax is due on it at all. This is called the 7-year rule, and it is one of the most powerful, completely legal tools available to anyone doing their own planning. If you die within those 7 years, the gift may still be taxed, but on a sliding scale. The tax owed reduces the longer you survive after making the gift, down to nothing at year 7. On top of that, every single year, you can give away up to £3,000 with number 7-year weight attached at all. It's simply outside your estate from the moment you give it. If you didn't use last year's $3,000, you can carry it forward 1 year and use both allowances at once. You can also give unlimited small gifts of £250 to as many different people as you like. Make wedding gifts of up to £5,000 to a child. And this is the one people underuse the most. Make regular gifts out of surplus income, meaning money left over after your normal living costs, with no limit and no waiting period at all, provided it's genuinely regular and genuinely from income rather than capital. None of that requires Parliament to pass anything. None of it requires you to wait for a bill to clear committee. It's already the law. It's been the law for years, and the only thing standing between you and using it properly is knowing it exists and keeping a clear paper trail, so your family isn't left arguing with HMRC about what a gift was for 10 years after you made it. Let me bring this together with 3 short illustrative examples. Again, not real people, just simple pictures to make the rules concrete. Picture a widower in Yorkshire. His estate, including his home, sits at just under £1,400,000. He's leaving everything to his 2 sons, because his estate is well under the £2 million taper and because it's going to direct descendants. He gets the full residence allowance on top of his nil rate band, plus whatever his late wife didn't use. In his case, a large share of that estate passes completely free of tax. The system, for him, works exactly the way the headlines promise. Now, picture a couple in Surrey with Northwest children leaving their estate to a nephew they've supported for years. Their estate is worth £800,000, well under the £2 million taper. On paper, that looks like a modest, comfortable estate that should sail through untaxed. But because their beneficiary isn't a direct descendant, the resident's nil rate band never switches on. They're relying only on the 2 basic nil rate bands, £500,000 combined, and the remaining £300,000 is taxable. Same care, same intentions, A materially different bill, purely because of that one sentence about who inherits. And picture a couple with a pension pot of £600,000 between them that they've deliberately left untouched, planning to draw down other savings first, and pass the pension on tax-free, exactly as advisors have recommended for years. Under today's rules, that plan works. From April 2027, that same pension pot joins their estate, and depending on its size relative to their total wealth, a meaningful slice of money they assumed was protected may not be. Same country, same tax year in 2 of those cases, 3 completely different outcomes, and in every case, the difference wasn't how much money there was, it was one sentence sitting underneath the headline number. Before I give you the checklist, one honest warning, because inheritance tax anxiety is exactly the kind of thing that attracts people who aren't trying to help you. If you get a call, a letter, or a knock at the door from someone offering to review your estate who contacted you first, be careful. Legitimate advice from a regulated financial advisor or solicitor is worth having. Inheritance tax planning genuinely is complicated enough that professional advice pays for itself, but you should be the one seeking it out, checking they're properly regulated by the Financial Conduct Authority or a recognized legal body, not responding to someone who came looking for you off the back of a headline like this one. And to be completely clear, because I'd rather say it plainly than have you assume otherwise, nothing in this video is personal financial or legal advice. It's an explanation of the rules as they currently stand, so that when you do sit down with a solicitor or a financial advisor, you're asking them the right questions instead of walking in blind. Here's your checklist. 6 things, and every one of them is something you can start this week. 1. Find out what your estate is actually worth today. Property, savings, investments and pension pots added together honestly. Most people have never done this sum in one place, and you cannot know which rules apply to you until you do. 2. Check whose name to inherit your home in your will. If it isn't going to children or grandchildren, know that the residence nil rate band will not apply and plan around the basic allowance instead. 3. If your estate is anywhere near £2 million once everything is added up, get proper advice on the residence nil rate band taper specifically. This is the threshold that catches ordinary, careful families who never thought of themselves as wealthy. 4. If you have a meaningful pension pot you've been planning to leave untouched, talk to an advisor about the April 2027 change before then, not after. The strategy of leaving your pension until last is about to change completely, and the earlier you review it, the more options you have. 5. If you're already gifting money to children or grandchildren, keep a written record of every gift, the date, the amount, and who it went to. The 7-year clock only helps your family if they can prove when it started. 6. If you're using the surplus income exemption, giving away regular money from what's left over each month, write it down as you go. A pattern proved after the fact is far harder to demonstrate than a pattern recorded at the time. Here's what I want you to take from this video. The headline number is always the same story, a big, comforting figure that sounds like it settles the question. £1 million tax-free, £500,000 tax-free, but underneath every one of those numbers, there's a sentence about who you're leaving things to, how big your estate actually is, or what kind of asset you're holding, and that sentence is the part that decides your actual bill. None of this is complicated once someone actually walks you through it. It's just rarely explained to the people it affects at the time it would actually help them plan. Go and do the sum this week. Find out what your estate is really worth, who it's really going to, and which allowances genuinely apply to you. That's the whole assignment. I'm Retired UK. Thanks for watching.